All right, ready to dive into One Up on Wall Street?
Let's do it.
You know, Peter Lynch, the guy who, basically made the Magellan Fund a legend.
Yeah, amazing track record.
He's got this way of making investing feel, I don't know, approachable. Like you could be picking stocks from your couch.
Right, but it's more than just like picking stocks. It's about understanding businesses, right?
Yeah, that's what I love about this book.
Totally. His whole philosophy is like, you don't have to be some Wall Street hotshot to beat the market. Like, everyday people can do this.
I mean, that's encouraging to hear.
Right. With a little common sense, a bit of work, you can outperform those fancy fund managers.
So how do we do it? What's the Lynch magic?
He talks about street lag, this gap between when a company starts showing promise in the real world, like, Main Street, and when Wall Street finally catches on.
Yeah, okay, I'm following.
Think about it.
Yeah.
You might see a new store like popping up everywhere, or a product that everyone's buying way before like the analysts even start paying attention.
That makes sense.
That's your chance. That's where you get one up.
Beating Wall Street to the punch.
Totally. He's all about turning what you see every day, those observations, into opportunities.
I like that.
He even breaks down different types of stocks, almost like, a field guide, helps you figure out what companies match your style, your investing personality.
So before we get into each chapter, what's the big takeaway? If you had to sum up the book's message, what's Lynch really saying?
It's pretty straightforward, actually. Investing shouldn't be like a guessing game. It's about understanding business.
The ones we see all the time.
Exactly. He argues that by using what you already know, your own experiences, you can spot the good companies before Wall Street does and ride that street lag wave.
To potentially, big returns.
Yeah, exactly.
Okay, so not day trading, not chasing the hot stock tip. It's about being an informed investor.
Being smart about it.
Wow.
Being a part owner of businesses you get that you believe in.
Okay, I like it. So, chapter 1, investing as a business. What's the deal with this opening chapter? What's he setting us up for?
It's really the foundation. He's saying treat stock picking seriously, not like, a casino trip.
No Vegas vibes.
Right. It's a business venture. You're researching companies, getting their financials, making decisions, but informed decisions based on, solid stuff.
So no throwing darts at a stock board. Got it.
More like, put in the work. He also warns against blindly trusting, quote-unquote, experts.
Ooh, taking on the experts. I like it.
Remember those fancy fund managers? He thinks they actually have some big disadvantages compared to, us regular investors.
Okay, now I'm really intrigued. Let's get into those 10 questions. So, first up, what are these advantages we have over the pros? What makes us so special?
Well, we're, nimble. We don't have all that red tape big institutions deal with.
We can move faster.
Yeah. We can invest in smaller companies, the ones maybe those big funds can't touch. And we don't have to worry about quarterly reports or, chasing every Wall Street fad. We can be patient.
Let it grow.
Exactly.
So it's like David and Goliath, but David's got a pretty good aim.
Perfect analogy. Plus, we can use what we know personally, right? Maybe you're a teacher, you have insights into education tech, or a doctor who sees, a new medical device taking off. That's a real edge.
It's real-world stuff, not just numbers on a screen. Okay, question 2. Why shouldn't we just follow the experts' stock picks? I mean, isn't that what financial advisors are for?
It's risky. Even the best analysts get things wrong a lot. They have biases, they chase trends, and sometimes they make choices that have nothing to do with the company's, actual value.
So following them blindly could, backfire big time.
Totally. It's your money, your future. You have to get the why behind every investment. Don't just take their word for it.
Do your own homework, right? Question 3. Risks. There's no sure thing, is there? What are the risks with different approaches?
Of course not. Every investment has risk. Putting money in a high-growth tech startup. Exciting, but risky, if it flops. Even something safe, like a bond, well, inflation can eat away at your returns.
It's finding that balance, right? Your goals, your comfort level.
Exactly. Informed decisions, not just hoping for the best.
Question 4. How do we shift from thinking about it as gambling to, real investing? What's this difference, really?
It shouldn't feel like a casino. It's about those calculated decisions, research, understanding, playing the long game. Think like a business owner, not a gambler.
Okay, not trying to time the market, get rich quick.
Yeah, it's about those fundamentals.
Got it. Question 5. This is interesting. Understanding our own psychology. So keeping our emotions in check.
You got it. Emotions can really mess you up. Fear makes you sell at the worst time. Greed makes you buy at the worst time.
So discipline, even when the market's going haywire.
Stick to the plan. Lynch talks a lot about having that plan, that investment plan, and not getting sidetracked.
Good reminder, good reminder. Question 6. How do we actually do that? Avoid letting fear and greed, run the show.
He's got some techniques. First, focus on the fundamentals, not the stock price bouncing around every day.
It's about the business.
Right. And diversify. Don't put everything in one basket. Different industries, different types of investments. That helps when one thing takes a hit.
Classic advice, but important. Spreading the risk. Question 7. Investment philosophy. Why is it important to have one to match our personality and goals? There are so many ways to invest.
Exactly. There's no one right way. Lynch says find what works for you. Your risk tolerance, how long you're investing for, what you want to achieve.
So not copying someone else. Find your own way.
Exactly. Are you okay with high risk, high reward, or more, slow and steady? Figure out what kind of investor you are and stick with it.
I like that. Okay, question 8. Realistic expectations. What can we really hope to achieve? We all want to hit it big, but what's reasonable?
Lynch is big on being realistic. The market has done well over time, but it's not a get-rich-quick scheme.
Ups and downs, for sure.
Yeah. Even the best investors have bad periods.
So no overnight millions. Set achievable goals. It's a marathon.
That's a good way to put it. Which leads to question 9. How do we keep that long-term perspective? It's so easy to get caught up in the day-to-day.
That's the trap Lynch wants us to avoid. That short-term noise.
Focus on the long-term potential of the companies, right? You're an owner, not someone just flipping stocks.
Tune out the noise. Focus on what matters.
Right. And finally, question 10. Mistakes. Everyone makes them. How do we get over the fear of messing up, especially when starting out?
It's intimidating,
It's natural to be afraid to lose money. But Lynch says, see mistakes as lessons. Even he shares his own blunders to show that it happens.
Even the pros mess up.
The point is, don't let fear stop you from investing. Do your research, make good choices, but learn from everything.
So jump in, but be smart about it. I like that. Seems like this first chapter is all about getting in the right headspace.
Yeah, building that foundation, understanding, research, long-term thinking.
Love it. All right, foundation's laid. Let's see what he throws at us next.
Well, in Chapter 2, The Wall Street Oxymorons, he's going after some of that conventional wisdom that, honestly, often leads investors astray.
Ooh, challenging the status quo.
Get ready for some myth-busting.
Let's do it.
Chapter 2, The Wall Street Oxymorons. This is where Lynch kind of throws some punches.
Yeah, love that. He's not holding back.
He goes after those Wall Street myths, the stuff that trips people up.
So what are some of these oxymorons? What's got him riled up?
Well, he starts with how limited professional investors actually are.
Really?
You'd think fancy degrees, all the data, they'd have it figured out, right?
Yeah, you'd assume so.
But he argues they have all these restrictions, these pressures that make it hard to beat the market.
Interesting. So it's not all it's cracked up to be.
Not exactly. What kind of restrictions are we talking about? Well, think about it. Many fund managers can only invest in certain stocks based on size, industry,
So rules. Their own rules.
Right. They might be blocked from investing in smaller companies, even if those companies have huge potential.
So they miss out because of, what, bureaucracy?
Yeah, kind of. And then they're judged on their short-term performance, like every quarter.
Yeah.
So much pressure to beat the market right away, it leads to bad decisions.
Focus on the quick win, not the long game.
Exactly. Plus, they have to kind of follow the herd. Don't want to stray too far from what everyone else is doing, even if their gut says different.
Stuck in the echo chamber.
Right. And all of this creates the opportunity for us, individual investors, if we're willing to think for ourselves.
Love that. All right, let's get into the 10 questions. So, question 1. Why do these pros, with all their resources, still struggle to beat the market?
Lynch says it's their own limits, not necessarily skill. Those restrictions, the pressure to conform, that short-term focus, it creates blind spots.
So their size works against them.
In a way, yeah. And street lag comes in here too. They're slow to react to new trends. While we're out there, seeing it happen.
Boots on the ground, so to speak.
Exactly. Okay, question 2. How do we use street lag to our advantage?
This is where it gets exciting. Lynch wants us to tap into our daily lives, the products we use, trends we see, what's generating buzz. That's valuable info.
Right. You might see that new restaurant that's packed every night or a store that's expanding like crazy.
Real world clues.
Yep. Question 3. Why is independent thinking so important? How do we cut through all the noise?
He's big on doing your own research, coming to your own conclusions. Don't buy something just because everyone else is. Understand it, make your own choice.
Remember, the crowd is right near the end of a trend, but usually wrong at the beginning.
Be the early bird.
Exactly.
Okay.
Question 4. Biases. We all have them, right? But how do they mess up even professional investors?
Yeah, that's interesting.
He talks about confirmation bias, where you only look for info that supports what you already think. Ignore the warning signs.
Ooh, yeah, I can see that happening.
And angering bias, getting stuck on that first piece of info, even if it's wrong or outdated.
First impressions matter too much.
Right. Got to be aware of these and actively seek out different viewpoints. Challenge yourself.
Don't get tunnel vision. Question 5. So how do we avoid these biases?
Be aware of them and look for info that challenges your views. Don't just read stuff you agree with. Get uncomfortable.
Step out of the echo chamber.
Exactly. And when you're researching, don't just focus on the good stuff. Look for the risks, the problems.
Balanced view.
Right. Question 6. Why do we need to understand what motivates those Wall Street analysts, the brokers? Aren't they on our side?
Yeah, good question.
Well, Wall Street is a business. They have their own goals. They might recommend stocks that make them money, not necessarily what's best for you.
So their advice might be, conflicted.
It can be. Got to take it with a
Dang.
grain of salt. Do your own digging before jumping in.
Always, always. Question 7. Groupthink.
Hmm.
How do we avoid that, everyone chasing the same thing?
That's dangerous. Everyone piles in, the price goes up, but it's not always based on, reality. And when things turn, everyone runs for the exits.
Create a stampede.
Yeah. Lynch says, think for yourself. Don't be afraid to go against the crowd if you see something different.
Trust your gut, but back it up with facts.
Love it. Question 8. Why have our own investment criteria? Why does that matter, especially when the market's crazy?
It's like having a plan, right? What are your goals, your risk tolerance? How long are you investing for? Then, how do you pick investments that fit all that?
Having that strategy helps you stay focused.
Yeah.
No rash decisions based on fear or, getting greedy.
Don't panic, stick to the plan.
Yeah.
Question 9. This goes back to street lag, right? Using our own knowledge to get an edge.
Totally. Lynch says we all know stuff that those Wall Street guys don't. What's happening in your industry, your town, the things you use every day.
Everyday life is research.
Yep. And lastly, question 10. How do we become better investors? More informed, more, savvy?
Yeah, with so much info out there, where do you even start?
Never stop learning. Read, follow companies, talk to people, ask questions. The more you know, the better choices you make.
Investing is active, it's not passive.
Exactly. So with chapter 2 done, we're seeing those limitations of the pros, the power of thinking for ourselves. On to chapter 3.
Is this gambling or what? That title, that's a big one. A lot of people struggle with that. Let's get into it. So,
Yeah.
Chapter 3. Is this gambling or what? Big question. I think a lot of people, when they think about the stock market, that's what comes to mind.
Yeah, I get it. It does have that, that image, speculation, risk, luck.
Right, like rolling the dice.
But Lynch is saying, no, there's a real difference. Investing, when it's done right, it's not gambling at all.
So how do we separate those two things? What makes it different?
It's about research, it's about analysis, it's about really understanding those businesses. You're buying into something, becoming an owner, not just betting on a price going up.
So it's more than just, watching the ticker go up and down.
Exactly. It's about the long game, looking at the fundamentals, the company's health, its, competitive landscape, all that.
Okay, so our 10 questions for this chapter. First one, basic but important. How are stocks different from, say, bonds? I think for a lot of people new to this, it can be confusing.
Stocks, you're owning a piece of the company. Bonds, you're loaning money either to a company or the government. So with stocks, you get a share of the profits. You're along for the ride as the company grows. Bonds, you get a fixed interest rate. It's more predictable.
So stocks, potential for bigger wins, but also bigger losses. Bonds, safer, but maybe not as much growth.
Right. There are variations within each, but that's the big picture.
Question 2, risks and rewards. What are we looking at specifically with stocks?
Well, the risks are real. The market can swing wildly, the economy can tank, the company itself can hit a rough patch, even global stuff can impact stock prices. You could lose money, sometimes a lot of it.
That's the scary part.
Yeah, but the flip side is, historically, stocks have done better than other investments over time. If a company grows, gets more profitable, your investment grows too. Plus, some companies pay dividends. That's a bonus.
So, potential for big gains, but got to be ready for the ride. Question 3. How do we tell the difference between, like, smart investing and just reckless gambling? Where's the line?
Lynch is all about research, that due diligence. If you're making a decision based on real knowledge, numbers, understanding the business, that's good investing. If it's just hype, emotion, or you want to get rich quick, that's probably gambling.
So facts over feelings.
Exactly. If you're buying a stock just because the name sounds cool or everyone's talking about it, that's not a good sign.
Question 4. This is more personal, right?
Yeah.
Knowing your own risk tolerance. Some people are more comfortable with risk than others.
Absolutely. It's different for everyone. Some people love the excitement, the ups and downs. Others, it stresses them out big time.
So how do you figure out where you fall on that spectrum?
Think about your goals. What are you investing for? Retirement, way in the future, or a house down payment in a few years? The longer you're investing, the more risk you can usually handle.
That makes sense.
And think about your emotions. If your portfolio drops 10% in a month, what do? Panic and sell. Or see it as a chance to buy more. That's telling.
Yeah, that's a good test. Question 5. This is practical. Having an investment plan. How does that help us stay disciplined, not make those impulsive moves?
Lynch loves the written plan. Your goals, how long you're investing, what types of investments, your risk level, all of it. It's your roadmap.
Keeps you on track.
Yeah, and when the market gets crazy, and it will, you go back to that plan. Stops you from making emotional decisions you might regret.
Question 6. Long-term perspective. Why is that so important when it seems like everyone's focused on the short term these days?
Because the market is wild in the short term, but over time, historically, it goes up.
So weathering the storm.
Exactly. The longer you invest, the more time you have for things to even out, and that's where compounding comes in. Your gains make more gains. It's powerful stuff.
Let time do the work. Question 7. Fear. A lot of people are afraid to lose money. It keeps them out of the market entirely. How do you deal with that fear?
It's normal to be afraid. Nobody likes losing money. But Lynch says, think of losses as like tuition. You learn something.
Mistakes are lessons.
Exactly. Everyone makes them, even the experts. The point is, don't let that fear stop you from getting started, from participating.
Question 8. Why focus on the company itself, the fundamentals, and not just the stock price? That price can be so tempting to watch.
Because the price is just a reflection of what's happening with the business, and sometimes that reflection is distorted. It's not always accurate.
Don't get caught up in the hype.
Right. Look at the earnings, the revenue, what makes the company strong, its leadership. That's what matters long term.
Question 9. Avoiding the hype. How do you stay grounded when everyone's going crazy for some stock or some trend?
Honestly, one way is to not be glued to the financial news. All those headlines, all those opinions, it creates anxiety, makes you want to jump in or jump out at the wrong times. Stick to your plan, do your own research, stay calm.
Tune out the noise. Last question for this chapter, question 10. This is a shift in mindset. Seeing investing as owning a business, not gambling. What does that do for us?
Lynch thinks it's really powerful. If you're an owner, you're more likely to do that research. You pay attention to how the company's doing. You make decisions for the long haul.
It's like you have a stake in it. It's not just a game.
Right. It's about being smart, informed, engaged.
Love it. Okay, so we've talked about the psychology, the importance of making good choices, doing the research. This has been a great deep dive.
I agree. Lynch really breaks it down.
And the best part, anyone can apply this stuff. You don't have to be a Wall Street wizard.
That's the whole point, right? It's about empowering everyday investors.
So to everyone listening, get out there, do your research, and remember, invest in what you understand. You might be surprised what you can achieve.
Thanks for joining us on this deep dive. Until next time.